You're listening to The Real Investment Show.
And welcome back to the show. This morning is, of course, Thursday. As I said, it's the second best day of the week because tomorrow's Friday, right? So get ready to wrap up this week. Already such a short week when Mondays are a holiday. So a lot of things to talk about this morning. You know, narratives are a really, really important factor of investing and being a successful investor over time. And most of the time, you just need to shut narratives off. There's always a reason, and this is, you know, we've discussed this on the show before, is that as humans, not as investors, as human beings, we always have to find a reason for why something is doing something. Why is the market up today? Well, it was because of this. Why is the market down today? Well, it was because of this. And most of the time has nothing to do with that at all. You know, one of my favorite stories I've shared here multiple times in the past is about IBM, and this was in 2000. And, you know, we're about to go into the dot-com crash. At the time, nobody knew it, but we were getting there. Anyway, the market's down in the morning very sharply because IBM announced 5,000 layoffs. And it was like, oh, this is terrible, right? This is just the recession's coming. IBM's laying off 5,000 people, and the market's down. By the end of the afternoon, the market had turned around, gone back up, and the reason why the market went back up is because IBM laid off 5,000 people. Now, that can't be true, right? But that's what the media needs, and that's what we as humans need to rationalize why something's going the way it's going. And so if I'm super bearish, right, I need to find bearish reasons for why I want the market to go down, which I've never really understood that with people. Why do you want the market to crash? But if I'm bearish and I want the world to end and I want the markets to go down, I need to find reasons for that, right? Or if I'm bullish, I need to find reasons for that. What our job is to just try to navigate what the markets are doing. And so again, there's now I'm not saying that narratives don't impact the markets, because they do in the short term, right? From one day to the next, there you know, a headline, something can certainly, especially today when we have so many computer algorithms and you know, other, you know, processes that are automated, managing money, managing markets, they are certainly reacting to the news, right? So the news headline hits and immediately the market will go down a lot because of that news headline. And then the markets will try to sort it out after the fact. So narratives are important, you know, in terms of moving markets short term. And so I'm not saying they're entirely irrelevant. I'm just saying that longer term, these narratives typically do not hold a lot of weight in the market over a period of time. And so again, we're going to talk more about this specifically and relates to the interest rates, the deficit, the markets, the dollar. These are a lot of the recent narratives that are kind of roaming around the markets right now. Michael, how are you this morning?
I'm doing great, Lance. How about you?
Good. So real quick, just before we get into that, anything on Nvidia's earnings last night that shocked or inspired or disappointed you?
I mean, I guess nothing from them is shocking anymore. Whatever everyone thinks they're going to do, which is already high expectations, they do a little better. Mm-hmm. And, you know, when you read some of the quotes from the CEO, you know, they're going to own this world at the rate they're going. You know, it's just amazing what's coming out of that company and the foresight. You know, it's
aliens,
and it's the same leadership, but they have changed. Oops, forgot my microphone. Sorry, Brent. It's the same leadership that they have had for a long time. Mm-hmm. But over the last 5 years, they kind of got into this AI thing, and that has propelled the company. They're, you know, right up there with Apple and Microsoft, which 5 years ago you would have told me, or I would have told you, you're crazy.
Right.
So they're just doing it quarter in, quarter out. Their margins are immense. The revenue growth, I saw someone posted revenue growth by quarter, mm-hmm. and it's just shocking how exponential. It's, you know, it's soon going to turn backwards and to the left. It's going at such a rate.
But no, it's important though too. I mean, you know, this is a, you know, and this is what I was saying earlier, is that we're at the cusp of what's going on with AI. So companies like Nvidia that are in that mix right now, it's not surprising they're growing as fast. That will slow down, right? There is a limit to growth. It's the law of large numbers. There's a whole variety of things that are out there. That growth will eventually slow down, but that could be well into the future. So one of the problems that investors have had with Nvidia that are, kind of anti-Nvidia, so to speak, is they keep expecting that revenue growth to stop like next quarter. It's like, oh, next quarter, the CapEx spending on data centers is declining. It's not, but that's what they keep expecting. And so they expect this very sharp turn down in revenues. There's no evidence of that right now, but it is important to note that this exponential growth rate in earnings is going to slow eventually, and revenues. It will slow eventually. It's just the law of large numbers as we get there. Going from $1 billion to $2 billion is one thing. Going from $100 billion to $200 billion is another thing. Going multiples of hundreds of billions is an entirely other issue, and they're eventually going to hit that point. The question will be, by the time they get there, how much money will be made or lost, trying to anticipate the end of this growth rate.
And I think, Warren Buffett talks about moats. And moats are basically advantages that some companies have that stop other companies from entering their business and crunching their margins. And Nvidia, it's interesting, they have a moat. That moat is technology. No one has been able to replicate or come even close to what they're doing. Both from the technology itself and now the production, how quickly they can turn around these chips and get them out to the market. But the problem is they also have, you can think about the moat around the castle. The problem is they have the Hope Diamond in the castle, and that's these massive margins. Mm-hmm. So even though there's a moat, every company wants to get into that castle. So, over time, you kind of talk about this can't last forever, and it won't last forever. And it's because those margins are so high. And there are so many companies that are like, we got to figure out what they're doing. We will take their employees. We will look at their patents. We will figure it out. And they will. Yep. They will figure it out. And those margins will come down significantly. So NVIDIA may still dominate the space that they're in now, and those sales may go up tenfold from where they are today, but those margins can contract significantly if other players like AMD can figure out how to just get into that business and settle for 50% margins instead of 70%.
Well, yeah, and again, look, and this, what's going on with AI in general right now is again, we're very young in this cycle. This is the early 90s in terms of the internet. We're just really starting to develop this. And there's going to be tons of companies coming out that are going to innovate new chips, better chips, different chips, whatever it is. Maybe we won't even be using chips in 20 years, right? I mean, it could be something entirely different. But, this reminds me a lot of Apple, Mike. When we go back and look at Apple, when they first came to the markets with the iPhone, they were growing by leaps and bounds. Their revenues were just, off the charts. They had these massive margins. Everything was just firing on all cylinders for Apple, and investors made a ton of money owning Apple over the years. Now we're to the point, though, and this is kind of the future of NVIDIA at some point, and this is just going to happen. They are still a dominant player in their industry. They still own a significant market share. There's really, nobody's invented the Apple killer yet in terms of the Apple iPhone. But the innovation has slowed down. Revenue growth has slowed down a lot. They're kind of treading water where they are. And this is what you should expect to eventually happen. For Nvidia, but that was basically about a 20-year cycle. Not quite that long, about 15 years. It took Apple about 15 years, from the introduction of the iPhone to get to that level where revenue growth is now starting to stagnate.
And here's what's interesting, though. You were comparing to 2000. Mm-hmm. you think about 2000. Is this like 2000? NVIDIA has a forward PE of 25.
Right.
Microsoft is 30. Apple is 26. Tesla is, God only knows what it is, 120.
Yeah.
It's fairly priced. That's the crazy part, that you rarely see a company growing at such a rate that is actually reflective of what's happening. And their PEG ratio, which reflects future growth, is, dare I say, cheap. It's cheaper, decently cheaper than the market. And according to like the Buffetts of the world, it's borderline a value company. So Nvidia is this unicorn, right? They have a technology no one can replicate, and it's fairly priced. We can argue about what that future growth rate is, and maybe Wall Street's being too optimistic, but it's amazing that the market is not as I know. Look, it's up. What's it up this morning? 5%,
6. Well, when I looked, it was up 6. Yeah, and
pretty close to its all-time highs again. Stop looking at the price and look at the valuations, and you'll see that it's not a Tesla. It's not a high flyer like we saw in the 1999s.
Yeah,
it's a different breed.
Well, it's just again, a lot of comparisons. I keep seeing a lot of analogs coming back. Again, going back to the narrative conversation, right? A lot of narratives about how this is like, AI is like 1999. They have the comparison of Nvidia versus Cisco, and what happened with Cisco after the .com crash. It's a very different environment for a lot of different reasons. Again, companies are profitable; they're making money. These aren't companies with no revenues, no business plans, no growth. So you've got to be careful with these narratives, particularly if you're taking a bearish angle to the markets, because you can lose a lot more money by missing out on the opportunities that are ahead of you. Now, look, we're not saying that AI is going to, just go off to the moon and never come down again. We're not saying that at all, but just be careful of the narrative that this is like 1999, because it's not, for a lot of fundamental reasons, more so than anything else. We'll come back. We're going to talk about interest rates and the dollar in terms of narratives as well. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Retirement looks a lot different now than what it did many years ago. It's just maybe working less. Still want to contribute and be active in the community.
And
absolutely.
Plus, when you're 70 and you can make TikTok channels and make money off of it.
The Real Investment Show podcast.
Is that what you're going to do?
I've already started it.
Oh, okay.
It's OnlyFans for old people.
Oh, my goodness.
At realinvestmentadvice.com.
Want to see my feet?
I'm out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So we're going to talk about, kind of continuing our conversation about narratives and the dangers of narratives in your investing and your portfolio and the decisions you're making about these. Now, look, if you're trading stocks from one day to the next, this isn't for you, right? Because from one moment to 1 hour to 1 day, narratives do matter, right? Because the Fed comes out and says something, something happens over here, and there's a headline news. Markets are going to react to that. But again, that narrative will change very quickly. Over the long term, though, a lot of these narratives that float around the markets really are worthless, because what drives markets long term over the course of months, quarters, and years is fundamentals, earnings growth, forward expectations of earnings growth rates, those type of things. Valuations, those are what matter. And so these narratives change all the time to fit a short-term trend. We talked about recently, we showed this chart of the short positions, not this one, Brent. We showed this chart of the short positions against the U.S. Treasury. Right now, there's a massive amount of shorting against U.S. Treasuries, record levels that we've never seen historically. It's by leaps and bounds larger than any type of shorting we've seen previously on interest rates. So Wall Street is on this narrative right now that it's the deficits that are causing interest rates to go up. No, it's really just short traders that are just shorting the bejeebers, technical term, out of bonds at the moment. So that's moving interest rates up. However, now you can bring this chart up, Brent. This is a long-term chart of interest rates, the 10-year Treasury rate, and the federal deficit going back to 1953. Now, what you'll notice is we've been running a deficit in this country since 1980. Back in the early 80s, interest rates were 10, 11, 12%, but it wasn't because of the deficit. We were running a deficit, but it wasn't because of the deficit then that we had high interest rates. It was the oil embargo. It was, the issue with interest rates is Paul Volcker. It was, Ronald Reagan, whatever it was. There's all these other reasons why interest rates were high back then, but it wasn't the deficit. When we got into the early 2000s, right, we had an even bigger deficit. 1990, 1993, we had a growing deficit, and interest rates were running at 7 and 8%. But it wasn't the deficit because interest rates were at 7 or 8%. It was other reasons. When we got into the financial crisis, we had a very big deficit. Interest rates were running about 5.5% back then. But interest rates weren't 5.5% back during the financial crisis, even though we had this massive deficit. It wasn't the deficit problem. It was the financial crisis. It was other stuff. During the Biden administration, we were running a $5 trillion deficit. Interest rates were at 0%, basically 0.5% on the 10-year Treasury. But the deficit wasn't the reason for low interest rates, right? And so now we've got a deficit of about $1.8 trillion, about a third of what we had during the Biden administration. And now interest rates are back where they were in 2008. The deficit really isn't that much bigger than it was in 2008. It's a little bit bigger, but not much. And now it's the deficit, but it wasn't the deficit back in 2008. It wasn't the deficit during 2020. So again, you've got to be careful with narratives because these narratives are changing all the time. And in fact, bring that chart up for me one more time, just real quick, Brent. I want you to take a really close look at this chart, though, about the deficit and this narrative that the deficit is the reason for higher interest rates. It's not. What the chart tells you is that interest rates have been falling for 40 years as the deficit has increased. The deficit actually leads to lower rates, not higher interest rates, because deficit spending on unproductive investments, which is how we spend money, takes away from economic growth. It's deflationary. And so the deficit narrative right now that interest rates are high because of the deficit really doesn't hold water. And this narrative will change. Whatever the next innovation is, if interest rates fall sharply because we go into a recession, it'll be, we're having a recession, interest rates are going down. Well, what about the deficit? You were saying the deficit was because interest rates to go up, but now interest rates are down because of a recession. What is it? So you got to be careful in investing because these narratives are going to change to fit the moment. It doesn't mean these narratives support the underlying fundamentals of what drive interest rates. And we're going to talk about the dollar in a minute as well. But Mike, your points.
Yeah, narratives are just stories that we tell ourselves, whether it's kind of forms in the media or large investors or whatever it is, that explain why something is happening. Sometimes they're right. A lot of times they're wrong. So you're talking all about the deficit being the narrative of the day and why bond yields are higher. I thought it was tariff-induced inflation. Wasn't that what we were told a few months ago? That these tariffs are going to create crazy inflation, right? The University of Michigan consumer sentiment says 7, 8, 9% inflation. Inflation is going to be crazy because of tariffs. Well, over the last 3 months, and it's not final, we're not at the end of the road, inflation has been lower than expected. Oh, and by the way, last night, the court pretty much threw out tariffs and bond yields are slightly higher today.
Right.
If tariff-induced inflation is why bond yields are so high, they should be rallying to some degree today. They're slightly higher. They should be moderately lower today. So it's not tariff-induced inflation anymore.
Exactly. We have a bond auction today. I believe it's the 7-year bond auction today.
Correct.
Yeah.
Correct. And everyone's scared because it's going to go bad and then everyone's going to sell auctions. And that's a funny point. So I wrote an article about narratives and I used the Treasury auctions as an example. And about 3 or 4 weeks ago, there was a really, really good 10-year auction. This 10-year auction was, I want to say, $42 billion of bonds. It was, so within auctions, you have direct bidders and indirect bidders. Direct bidders are the primary dealers for the Treasury. It's 20 or so of the largest banks in the world, and it's their job to make sure that the bonds are bought and distributed. So if there aren't enough indirect buyers, they're the ones responsible. So one of the statistics we look at for auctions is what percentage of the auction did these direct bidders, these big banks, take? And the more they take, it means the less demand there is from really the end users. And it's one of a few stats that help us try to dissect how these auctions went for whatever that's worth. And we can debate that another day. But this was the third lowest on record that banks took from the auction, meaning that demand was off the charts from everyone else. The bond market was pretty much flat that day, despite a 10-year auction, which is one of the most followed bonds, and a very, very good auction measured numerous ways. 2 weeks later, we have a 20-year auction. No one cares about the 20-year. It was less than half the size of the 10-year auction.
It was a third of the size. It was $15 billion.
A third of the size of the 10-year auction. And it's just not a sector people follow. It's kind of an orphaned bond sector. And it trades slightly higher in yield than it should because of that. So there are advantages from an investor's perspective. But regardless, the auction was, it was deemed horrendous and horrific and horrible and a clear sign that the Treasury could not fund itself going forward anymore. This was the end. The dollar is collapsing. The Treasury is going to have to put up a for sale sign. This is over. and if you look at the auction results, it was meh. It was, I guess you could argue that maybe, it was slightly below average. There was nothing awful or horrendous or horrible about it. It was a mediocre to poor auction, of which there have been plenty before COVID, after COVID, throughout the years. So that's gives you a little bit of idea how these narratives form. You have two very equal events, both auctions. One was off the charts for a much more important bond. No one cared. One was for a very under-followed bond that no one really cares about its yield, and that's the one. Yeah, that's the one they focused on because it told the story.
Yeah, I've got the chart. So you wrote an article about this, like you said, and so I pulled this chart up. But this was the chart of the 20-year auction and how horrible it was relative to everything else. And what's important to notice when you look at this chart is that, so it's that red line on the far right-hand side. So it says red bar down, and you'll notice that it's about half of what these normal bad auctions look like. But these auctions are all over the place. You can have a bad auction one week and have a good auction or 1 month and a good auction the next month and a bad one. There's no trend. There's no analysis you can apply to this that says there's any type of statement that's coming out of this, whether it's an auction, a good auction or a bad auction, what's it going to be? These are small movements in terms of yield and buyers versus and sellers in these markets. But there's nothing here that says that, this was a terrible auction and now, the country can't fund itself. If there was a clear trend to this, like every single auction was just getting worse and worse and worse and worse, then maybe you could build a case out of it. But when it's all over the board, it just doesn't really tell you anything about what's happening in the bond market. But again, this goes back to the narrative, Mike, right? One thing that you and I talk about a lot is that going into auctions, these primary dealers short bonds a lot. They bring the yields up, they bring the price down so they can buy them cheaper at auction because they've got to turn around and sell them off to clients after the auction. So they want to make money at it too. So, when you have auctions, it's not surprising to see yields rise slightly. It's just because of what the dealers are doing in the market that day. Has nothing to do with the narrative of the deficit or the end of the world or whatever it else is. So important to keep that in perspective. But we'll come back. We're going to talk about deficits. Sorry, not deficits, but inflation next, and the inflation narrative that's going on right now as well, because it's not what you think either. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How confident are you in your retirement income strategy? Join RIA for a powerful in-person workshop designed to help you build a sustainable, tax-efficient income plan for retirement. Richard Rosso and Danny Ratliff host the RIA Retirement Income Empowerment Workshop, Saturday, June 14th at the Hyatt Centric in the Woodlands. Learn how to protect your nest egg, optimize Social Security, reduce taxes, and create income that lasts. Register now for the RIA Retirement Income Empowerment Workshop with Ratliff and Rosso at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just talking a little bit about narratives, and again, just from an investing standpoint, it's very important to take these narratives and set them aside and look at the fundamentals. If you're investing longer term, now if you're trading and you're in this for today or tomorrow, and that's it, narratives matter a lot, right? Because that's what's going to move markets. So you basically trade on headlines, and that's fine. There's nothing wrong with that. But the problem that investors get themselves into repeatedly over time is they get attached to a narrative. They hear somebody on some YouTube channel or they read some article and it says, here one of the latest one is the end of American exceptionalism, right? Everybody's going to move their money now from the U.S. over to Europe. Really? You're going to move your money into Europe because you think the end of American exceptionalism is here when we're in the middle and the leading edge of AI development. This sounds like a smart move, right? You're going to move your money to countries that are dependent on the U.S. for a massive amount of their imports. They have slowing economic growth. They have a tremendous amount of debt. You're going to move your money there because you think the end of American exceptionalism is over. This is the problem with narratives. Again, when you get back into these realities, things don't pan out. And this is, one of the things that we've talked a lot about lately is this whole idea of inflation. And, inflation is going to be spiking. If you take a look at the University of Michigan, Mike brought this up a little earlier. Take a look at the University of Michigan Consumer Sentiment Index. Inflation expectations are like 9% right now, 8-9%. We're going to have this massive surge in inflation. Okay, let's get down into the numbers, and you find out that that's heavily politically biased. Since Trump was elected, Democrats now, who had no inflation expectation under Biden, now have this massive inflation expectation under Trump. Conversely, it was just the opposite with Republicans previously. They expect a lot of inflation under Biden. Now they expect no inflation. So that really doesn't tell you anything about where inflation is going. That's just people's expectations. So we need to look at the facts that actually drive inflation and why did we have inflation before and what is going to create inflation in the future. And so if you go back to 2020, 2021, 2022, why did we have inflation? Because we shut down the economy and we sent people money to spend. That creates inflation. We don't have that today. What we have is consumers that are starting to see rising delinquency rates, rising default rates. They're running out of money. All that stimulus they had before is now gone. Student loan payments that were on deferral are now the government is actively going out to collect student loans, garnishing wages, etc. That doesn't promote consumption within the economy. And where does inflation come from? Inflation doesn't come out of the ether. Inflation is a function of supply and demand within the economy. It's people buying too much stuff, and there's not enough supply for them to buy. That allows producers to raise prices. That's why tariffs aren't inflationary. Tariffs are a tax. You may create a short-term price bump if you can pass on that tariff to consumers. But at the end of the day, if consumers don't buy the product, you have consumer choice, you've got consumer elimination, and you've got consumer change. So if consumers don't buy that product, Walmart, as an example, can't raise their price. And they've already said this. They said we may be able to pass on some of the tariff costs to our consumers, but they're a low-cost provider. The people that shop at Walmart, they're looking for low prices. If Walmart tries to pass on too much of that tariff to them, they will go shop somewhere else, or they just won't buy the product. And then Walmart has to make the decision to eat more of that tariff. And we're seeing that now in the in the producer price index, as well as the CPI index. You look at the spread between those two, we can see right now that producers are having to eat more of the tariffs than not. And that's why historically tariffs are not inflationary. And even Goldman Sachs just came out the day before yesterday, and they have now revised their outlook for inflation due to tariffs. In fact, have completely wiped it out. So they're expecting lower rates of inflation into the end of this year and into next year, not higher. Mike?
Drove inflation higher in 2022, 21, 23. It was supply. Let's just put supply off for now. It was insatiable demand. Combination of massive stimulus and the fact that a lot of people hadn't spent money in a year or two prior and they were catching up. So demand is a function of how much money we have and how confident we are. Are we willing to spend it? Do we want to spend it? Are we comfortable with our finances? Right now, consumer confidence, it did jump. The Conference Board's consumer confidence jumped, but it jumped from the lowest level since May of 2020 when the country was in lockdown. It's still at a very low level. So the confidence is not there. And Lance, like you just said, there's a lot of debt that has to be paid back, and that's creating weaker demand, as we've been seeing. The second part of it is, how much money do we have? What's the money supply doing? If you have a fixed money supply, you can't really have inflation. You can have inflation in individual goods. Some goods can go up, but then by default, some goods have to go down because consumers have a limited amount of money. So you look at the money supply and it's barely growing. It's below historical rates of growth and certainly below the massive growth in the money supply that we saw in 2021, 22. So look, we may see the price of some goods that are tariffed get passed on to consumers and they may go up. That's inflation for that product. When we talk about inflation, we're talking about inflation in aggregate for the things that we spend money on. And there's no indication that we're going to get a huge surge of inflation. Now, the statistics are pretty flawed, the way they calculate them. So sure, we could get a couple months of higher inflation because of the tariffs, because they don't immediately say, well, yeah, the price of cars just doubled, but no one's buying cars. It takes a while for that to filter through. But if they are spending twice as much on cars, they're spending a lot less on many other things. So, like you said, Goldman Sachs just completely walked away from their tariff inflation thing. My guess is the Fed is going to start walking that same line in a couple months if it becomes apparent that tariffs aren't creating inflation. And now that, we just found out last night about this International Court of Appeals, and it's going to go to the Federal Court of Appeals and then maybe the Supreme Court. But if the tariffs really are stricken or largely stricken, then that whole tariff-induced inflation is gone. And if you really focus on the economy, it's borderline disinflationary or deflationary. The pressures on prices is not higher. Tariffs are really the one thing people can stand at and say, well, this is going to cause higher prices. That's what the Fed's doing. So you could see that narrative change quickly if this really gets through to the Supreme Court and Trump says, you know what? I can't do anything about it. We're not going to have tariffs. We may do some other things, but there aren't going to be tariffs. So, there's still a lot in the air, but these narratives, this all comes down to narratives and trying to explain why bond yields are higher. They're higher because there's more people that are incentivized to push yields higher than to push them lower. And
for now,
you see this throughout history. Yields were very low when inflation was starting to go to the moon. It was near zero. Fed funds were at zero. Short-term rates were at zero when inflation was starting to really move higher. Where was the narrative then? The narrative was that rates were very low and we're going to stay low forever. Austria was issuing 100-year bonds at an interest rate of what, a quarter or 0.5%? Right. Now you got the opposite kind of narrative. Anything that supports higher yields is the story of the day.
And again,
it's what gets clicks.
Right. And the one thing that people are forgetting too about higher yields is that yields are ultimately a function of economic growth, inflation, and wages. And that's because that's demand in the economy. So we go back to what you just said, right? It's all about supply and demand at the end of the day. That's where prices are derived from. That's where inflation comes from. And so if you have economic growth at 2.3, which is where we are now, you're running inflation at 2.3, that's 4.6. It's about where yields are trading. So yields are about where they should be relative to the economic growth in the economy. And, everybody's like freaking out like this is some high level of interest rates. Interest rates were here back in 2008, and they were considered low back then. We had low interest rates in 2008. We were like all excited. I remember back in 2000, I was trying to sell CDs at 8% to people, and they wouldn't touch them. In January of 2000, I was like, you should be in the CD. It's 8%, FDIC insured, guarantee of principal, because we got problems coming with this whole .com thing. People wouldn't touch them because they were convinced the market was going to keep running up forever. That was 8% on the CD then, and we're at 4% today, and everybody's like freaking out that this is high interest rates. But we also have to remember, though, the Fed has interest rates at 4.33%, which is restrictive relative to where economic growth is right now. And central banks around the world, not just in the U.S., but around the world are reducing their balance sheet expansion, not increasing it. So, right now we have the whole central bank backdrop out of the market in terms of, quote unquote, controlling interest rates. So if there's ever a problem, you can bet your bottom dollar they're going to show up pretty quick. Mike, you've got 20 seconds.
We just saw this in Japan. They just said they're changing the way they're issuing debt, and their yields fell 40 basis points overnight in 30-year bonds. So there's a lot of tools in the playbook for the Fed and the Treasury.
Yeah, just again, a big story today is don't fall victim to narratives in your investing portfolio. It's about building wealth. Do what works long term, building your wealth, and leave the narratives for bloggers and YouTubers and those type of things. All right, have a great day. We'll see you back here tomorrow for Financial Fitness Friday and back on Monday. See you then.